All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer nothing in this podcast or any of our other materials should be taken as investment advice. James or I could have positions in any of the stocks that we mentioned, and we may change those positions at any time. So make sure to always do your own work and consult with a professional before making any investment decision. So with that being said, the topic of today's video is going to be Bitcoin mining. It's been a while since we did a video on the Bitcoin miners, and a lot has happened since then with the price of Bitcoin and the election and everything. So it's important to periodically come back and reevaluate things, see if anything has structurally changed. So that's going to be the topic of today's video. For those of you who may not be as caught up on our perspective on the Bitcoin mining industry, we view the Bitcoin mining industry as structurally unfavorable for three main reasons. The first is that the main revenue source is perpetually decreasing. Second is that they have significant cost of goods in major electricity costs. And then finally, significant capital costs. All those three put together, and we see that no miner to this date has ever been able to become profitable. So the first point, that the mining revenue is always decreasing, that is because most of the miners' revenue comes from block rewards, which happens when they successfully mine a Bitcoin. Now, these block rewards are constantly decreasing because in the original source code for Bitcoin, there is a provision such that the block rewards are cut in half every 4 years, and that's to prevent the supply of Bitcoin from increasing to infinity. So basically, every 4 years, the block rewards gets cut in half. Most recently, that was in 2024. It was a major disaster for all Bitcoin miners. The second unfavorable structural factor is that the high electricity costs of mining Bitcoins massively creates a massive cost of goods sold for the mining business model. As of the most recent data, it costs about $35,000 of electricity per Bitcoin mined. For perspective, that's over half of the value of each Bitcoin mined in quarter three across a lot of the major Bitcoin miners. So obviously a huge cost of doing business for the Bitcoin miners, and kind of puts a floor on what the price of Bitcoin needs to be if you want to even hope to generate a gross profit. And finally, we have the extremely high capital expenditures necessary to operate a Bitcoin mining company. So these high capital expenditures are in the form of Bitcoin mining rigs. In the Bitcoin mining industry, the overall worldwide hash rate is constantly increasing because the technology for mining Bitcoin is constantly advancing very, very quickly every single year. Because of this, in order to stay competitive, and even to just maintain the amount of Bitcoins that you are able to mine, you have to constantly be upgrading and adding new mining rigs to your operation. And this is a huge expense. Overall, as of the most recent available data, this costs about $40,000 worth of mining rig depreciation per Bitcoin that you are able to mine. So this is a cost that is normally classified as depreciation and amortization, but you can think of it as it may as well be a cost of goods sold, because it's something that you have to do every single year if you want to stay competitive in the industry. As a result of all of these factors, Bitcoin mining is a very unprofitable business. And as of the most recent quarter and the most recent available data, no major US Bitcoin miner has been able to become profitable. And in fact, most of them are even generating even hundreds of millions of dollars worth of losses. So with that being said, I'll hand it over to you, James, to talk about what has happened in the Bitcoin mining industry since the last time that we went over.
Yes, thank you. So obviously the biggest development that's happened related to Bitcoin over the past recent few months has been the recent election of Donald Trump. And the reason why that's significant for Bitcoin and Bitcoin miners is that Trump has positioned himself as a very pro crypto president and pro Bitcoin president. So the election of Trump has caused huge excitement in the world of Bitcoin and crypto in general. We see over the past month, as a result of the election, the price of Bitcoin has increased by more than 40%. And here, if we look at the blue line is the Bitcoin mining ETF, which is an ETF that tracks a bunch of publicly traded Bitcoin miners. That has also increased in price by more than 20% since the election, as investors are optimistic about Bitcoin and Bitcoin miners because Trump is a pro Bitcoin president. But what does it exactly mean to be a pro Bitcoin president? Well, here are a few things that Trump has said, and these are why investors are so excited about him as it relates to Bitcoin. First of all, Trump has made certain comments about the United States making a strategic Bitcoin reserve. So, specifically, in a recent speech, he said, "If I am elected, it will be the policy of my administration, United States of America, to keep 100% of all the Bitcoin the US government currently holds or acquires in the future." So he's saying that whatever Bitcoin the US government happens to own, they will hold it and not sell it. So as it turns out, as of today, the US government currently holds 207,000 Bitcoins, and those Bitcoins are worth at current prices approximately $20 billion. And the theoretical maximum supply of Bitcoin is 21 million Bitcoins. So 207,000 is almost 1% of the total supply of all Bitcoins. So why does the US government, how did it end up being the case that the US government owns so much Bitcoin? Well, the only reason why the US government owns so much Bitcoin is because as the government, like the FBI or whatever, cracks down on various criminal organizations, a lot of criminal organizations use Bitcoin to do their transactions to avoid, that way they can avoid the traditional financial system. So Bitcoin can be very useful for money laundering and such things. So when the FBI, cracks down on some criminal organization that organization holds Bitcoin, the FBI will seize that Bitcoin, and that Bitcoin becomes in the custody of the government. And there have been some very significant cases. If you remember when Silk Road, back in the day when the Silk Road dark web marketplace was cracked down and shut down by the FBI, well, Silk Road had a ton of Bitcoin and the FBI seized all that Bitcoin. And there's been many other examples of various criminal organizations. And this has been very significant. And to date, right now, the US government has 207,000 Bitcoins. Historically, as these cases that the government is prosecuting, as these cases work their way through the courts, eventually the government's policy is to sell the Bitcoin, and just keep the US dollars, and then do whatever the court tells them to do with the US dollars. But it's a very long, protracted, legalistic process. So they could seize some Bitcoin from a criminal organization. This could be tied up in the courts for many years. In the meantime, the government is just holding the Bitcoin. Up until now, the policy of the government has been to eventually sell the Bitcoin, but Trump is saying we're not going to sell the Bitcoin. We're instead just going to hold it. Now, on its face, that does indeed sound like it's bullish for the price of Bitcoin, because there is this supply, there's this amount of Bitcoin that is now going to be permanently, if the US government holds this Bitcoin forever, it's never going to enter the market. So that is effectively meaning that this Bitcoin will never enter the circulating supply. And based on supply and demand, that should be bullish for the price of Bitcoin. However, it is unclear if Trump would even be able to create a national Bitcoin reserve in the way that he's talking about now. Because in addition to seizing Bitcoin from criminal organizations like the Silk Road, another large source of the Bitcoins that the US government holds are related to cybercrime, where some cyber criminal steals Bitcoin and those Bitcoins are stolen. And then you would presume the government seizes that, and the goal would be to eventually return the Bitcoin to the victims. For example, of the 207,000 Bitcoins that the government currently owns or currently has custody of, 95,000, or almost half of them, are related to the Bitfinex hack. So Bitfinex is a crypto exchange. All the way back in 2016, some hacker was able to hack into Bitfinex and steal these 95,000 Bitcoins. In 2022, the government was finally able to identify this hacker and arrest him, and they seized the 95,000 Bitcoins. This case is still working through the courts, but the expectation was that these 95,000 Bitcoins would eventually be returned to the victims, the people who were hacked back in 2016. Now, so even though the government has custody of these Bitcoins, the government doesn't really own them as such. So it is unclear legally if Trump would even be able to keep those Bitcoins, because maybe the court would say those have to be given back to the victims. So it's not even really clear if this strategic Bitcoin reserve is even going to happen, if it's even, legally possible. And anyway, Trump has never talked about the US government, taking its own money to go out into the open market and buy Bitcoin on the open market. Trump has never said anything about that. The only thing he has said is not selling the Bitcoin that the government acquires through law enforcement activities. And this is only about 1% of the total supply of the Bitcoin. So it's important not to overstate this. Now, the second thing related to crypto is that Trump says that on day one, he will fire Gary Gensler. Gary Gensler is the current chairman of the SEC. He has become very unpopular amongst the crypto community because he has cracked down against various crypto exchanges for allegedly selling many cryptocurrencies that he considers to be unregistered securities. So, we've made videos on our main channel, Wall Street Millennial, about kind of the SEC's lawsuit against Coinbase, and some other crypto exchanges related to these what they consider to be unregistered securities. However, this does not impact Bitcoin itself because the SEC has been clear. The SEC does not consider Bitcoin to be an unregistered security. Gary Gensler was not cracking down on Bitcoin. He was cracking down on other cryptocurrencies like Ethereum, Cardano, Solana, and a lot of these other cryptocurrencies, which are very different and have a lot more security like properties. And the SEC was alleging that some of those other altcoins are securities. The SEC never alleged that Bitcoin is a security, and there was never any intention of the SEC to crack down on Bitcoin itself. So the Gary Gensler being fired and Trump putting in a pro crypto SEC chairman, that could have a big impact on other altcoins, but there will be no direct impact on Bitcoin itself because Bitcoin it's irrelevant. Now it's irrelevant for the purposes of this whole debate about unregistered securities and such. So that should not directly impact Bitcoin. The final thing that Trump has said, and this specifically relates to Bitcoin miners, which is the topic of today's video. So this is very interesting. So, this is back in June. Trump tweeted, "Vote for Trump. Bitcoin mining may be our last line of defense against central bank digital currencies. Biden's hatred of Bitcoin only helps China, Russia, and the radical communist left. We want all the remaining Bitcoin to be made in the USA. It will help us be energy dominant." Now, this tweet is very difficult to understand what Trump is actually saying because he's clearly in favor of Bitcoin mining, right? And he wants Bitcoin mining to be done in the United States. And he says that it will help us be energy dominant. Well, I'm not sure how Bitcoin mining will help the United States become energy dominant. It seems like it's actually the opposite because Bitcoin mining does not create any energy. Bitcoin mining consumes energy. And the more energy you consume, the less energy you have left over for other stuff. So by increasing demand for energy and consuming energy, I don't see how that's going to help the United States become energy dominant. It's unclear if Trump even understands what Bitcoin mining is, to be clear. And there's no suggestion that Trump would even do anything that would benefit Bitcoin miners in any way. There's no suggestion that he's going to do any subsidies for Bitcoin mining or anything like that. And as far as regulation, there have indeed been some states and municipalities that have talked about maybe wanting to regulate Bitcoin mining because they're concerned about the strains that this puts on the electrical grid. But the federal government, the Biden administration, has not taken any action against Bitcoin miners or any regulations that are harmful to Bitcoin miners. So there's really, Trump wants to relax regulations at the federal level. Biden wasn't even targeting Bitcoin miners. So there's really no regulations to relax. So Trump can talk about Bitcoin mining. It's unclear that he even understands what Bitcoin mining is, but there's no suggestion that he's actually going to implement any policy that will benefit Bitcoin miners. Now, with all that being said, even if it is what it is that after the election of Donald Trump, the price of Bitcoin has indeed surged approximately 40%, all the way up to $98,000 approximately as of the time of recording this video. So Bitcoin miners, they generate Bitcoin. The greater the price of the Bitcoin, that the greater the revenue that they generate as denominated in US dollars. So a increase in the price of Bitcoin is obviously a benefit to the Bitcoin miners. as Ryan explained previously, as of the third quarter, all of the major Bitcoin miners were losing money. Well, now that the Bitcoin price has increased, will that be enough to help them to become profitable? Well, so let's take a look. So up on this chart here, I have selected a handful of Bitcoin mining companies, and we can look at their unit economics. So starting off with Riot Platforms. So Riot Platforms mined in the third quarter of 2023, which is the most recent quarter we have available. They mined 1,104 Bitcoins. They incurred direct operating costs of $39 million, excluding depreciation. They incurred $44 million of depreciation. And if you add those together, their all in cost, including depreciation, was $76,000. So that on the surface sounds pretty good, $76,000, because that is now lower than the price of Bitcoin. So currently the Bitcoin price is $98,000. So at least if we look at last quarter's number, their cost is lower than the price of Bitcoin, which is a good thing. However, we also have to consider their selling and general administrative costs, which were $67 million in the quarter. If we add their selling and general administrative costs, basically their corporate overhead, well, then their cost per coin goes up to $136,000, which is even higher than the current Bitcoin price. And another thing that is very interesting that we'll delve into more detail later is that one of the biggest factors that changes the cost to mine each Bitcoin is depreciation. And with depreciation, the depreciation expense that you recognize is dependent on the estimated useful life that you claim for your mining rigs. So previously, last year, Riot platforms depreciated their mining rigs based on an estimated useful life of 2 years. Then in 2024, they changed that. And now they say instead of depreciating our mining rigs over a lifespan of 2 years, we will depreciate them over 3 years instead. And if you increase the estimated useful life, the depreciation expense is spread out. So the depreciation expense in each quarter becomes lower. And if you just used the 2 year useful life, which is what Riot blockchain used to use as of 2023, then the depreciation expense would have actually been $65 million. The cost per coin, the gross profit, the cost per coin would have been $95,000 before corporate overhead, and then after corporate overhead, the cost would have been $155,000. Right. So the point I'm trying to make here is the useful life that you choose, that the estimated useful life of the Bitcoin mining rigs has a huge impact on the cost per coin. And the management teams of these companies have significant discretion over the useful life that they choose for their mining rigs, although it does have to be signed off by their auditor. So there is some accountability in that case, but we will delve into the depreciation stuff in a little more depth on the next slide. These Bitcoin production numbers are from the third quarter of 2023, which is the 3 months ended September 30th, 2023. Well, it's already been almost 2 months since then. And as Ryan explained earlier, the difficulty rate, the global hash rate of the Bitcoin miners becomes more and more competitive very quickly as new mining rigs are deployed across the industry. And this is especially true when the Bitcoin price is rising, because as the Bitcoin price is rising, that provides motivation for more Bitcoin miners to expand their hash rate to try to take advantage of that. And since the end of if you can see here, since the end of the third quarter, the difficulty rate has already increased massively. So that means that for any given amount of hash rate that you have, the number of Bitcoins that you will be producing is decreasing. And then a decreasing but your costs are the same. So as the number of Bitcoins, that you mine decreases, and your cost remains the same, that means your cost per Bitcoin is going to increase. So the difficulty rate increases so fast that the Q3 cost per coin numbers are already out of date, because those numbers, the cost per coin is actually going to be even higher now that the difficulty rate has further increased. But basically, the whole point of this slide is saying that, especially if we consider the corporate overhead, the major mining Bitcoin miners, they're still losing money even after the recent rally. And so now let's dig a little deeper. So as we explained earlier, Riot blockchain, they used to depreciate their miners over the course of over an estimated useful life of 2 years. Recently, they've extended the estimated useful life to 3 years. And so this here is from their most recent Form 10Q, where they explained why they did this. So here, this is from Riot Platforms. Effective January 1st, 2024, as a result of new information about the useful lives of Bitcoin miners, the company determined the estimated useful life of its Bitcoin miners will be increased from 2 years to 3 years. In making this determination, the company took into consideration its first-hand experience of miners remaining in service beyond a 2-year period, as well as the increased use of immersion-based mining, which the company anticipates will extend the useful life of miners due to improved heat removal and reduced exposure to particulates. Okay, so basically they're saying that previously they were saying their assumption was that the Bitcoin miner will only last for 2 years. Now they're seeing we can actually use them for up to 3 years because we're using this more advanced cooling method, which helps maintain the physical condition of the mining rig. So therefore, it doesn't go bad as quickly, it doesn't break down as quickly, and we can continue using it. Well, there's a very important concept we have to talk about, which is there can be the physical useful life of the mining rig versus also the economic useful life of the mining rig. So physically, if you take better care of it, or you maintain it better, or in this case they're using a more advanced cooling method, which is less stressful on the mining rig, so therefore it physically lasts longer. So previously maybe the mining rig would break down and literally just stop working after 2 years. Now they can use it for 3 years. Okay, that's one thing. But we also have to consider that the difficulty rate is increasing all the time. So even if the mining rig is kept in perfect condition, it is going to be producing less and less Bitcoin each year as the difficulty rate increases. And eventually it's going to get to a point where it becomes outdated, and that the amount of the cost of electricity that you have to use to power that mining rig is greater than the value of the Bitcoin that it can mine, because as the difficulty rate increases, the number of Bitcoins that it mines decreases, if that makes sense. So even if you keep the mining rig in perfect condition, it's going to be producing less and less Bitcoin over time, and eventually it will no longer be worthwhile to keep it operating. And to quantify this chart here, the hash price index. So what the hash price index is, it says if you have a given hash rate, and hash rate is a measure of computing power. If you have a given hash rate deployed, how many Bitcoin will you generate per day? And there are two things that impact that. One is the block reward. So the size of the block reward. As Ryan explained earlier, every 4 years there's a halving event. The block reward is cut in half. That obviously is going to reduce the hash price, right? And the second thing is the difficulty rate. As the difficulty rate increases, the hash price also decreases. And if we combine those two together, we get the hash price index. The hash price index takes into account both of those factors. Now, if you just look at this chart, over the past 5 years, the hash price index has decreased by 97%. So that means if you had a given mining rig 5 years ago in 2019, and that mining rig generated 1,000 Bitcoin per day. Now, it's obviously not possible to generate 1,000 Bitcoin per day, but for the sake of argument, right? You had a giant mining rig that mined 1,000 Bitcoin per day. You keep it in perfect condition. In 2024, that same mining rig is only generating 3 Bitcoin per day. is only generating 30 Bitcoin per day, right? A 97% reduction. Now, if you calculate that, a 97% reduction over the course of 5 years is equivalent to a 16% reduction in hash price per quarter. So every quarter that you operate your mining rig, on average, it's the amount of Bitcoin that it mines decreases by 16%. Now, this is very significant, and one of the problems with the way that depreciation is measured is that most, the Bitcoin miners and basically all companies measure depreciation based on what is called the straight line method, the straight line depreciation method. And what that means is, let's say, using a more conventional example, you have a business and that business requires you to own a truck. Okay. You buy a pickup truck and it costs you $10,000 to buy the pickup truck. That pickup truck, you use it in your business, and it has an estimated useful life of 10 years. So after 10 years, that pickup truck is going to break down and you have to replace it. So because the cost of the pickup truck is $10,000 and you depreciate it over 10 years, you recognize $1,000 of depreciation expense each year. And for most assets like the pickup truck, so long as it is working, it does its job. A truck is a truck. In terms of its economic utility, the 1-year-old truck is pretty much the same as a 9-year-old truck. Both of them can get the job done. Until it breaks down at year 10, the pickup truck is basically at a constant level of utility insofar as what it can do. And under that type of situation, that is then the straight line depreciation method makes sense. Bitcoin mining is very different. Even if the Bitcoin miner, you can use it for 3 years, the utility that it produces is not constant. So in the beginning, it produces a lot of Bitcoin. As the difficulty rate increases, the number of Bitcoins that it produces decreases over time. And I created this chart here showing a hypothetical example based on the 16% quarterly decline in hash price. So, say you have a given mining rig, it starts off producing 100 Bitcoins in the first quarter. Well, each quarter it is decreasing. The hash price is decreasing, so the number of Bitcoins that you mine is decreasing. And then there's a 3-year estimated useful life. And then, so conceptually, you can think of that as you have to replace the miner after 3 years. So in the first quarter, of 2028, that's when you replace it. Once you replace the mining rig, you get a new one that's with like the latest and greatest technology. It's more efficient, and then your production goes back up to 100. But then it starts declining again as the hash price index continues to decline. Now, you can see it's not a constant level of utility. The utility of the mining rig is decreasing over time. So if you just if you were starting at the beginning and you see, oh, okay, I'm producing 100 Bitcoins per quarter, if you just extrapolate that exact same level of production, you would think that over the course of 3 years, you would produce 1,200 Bitcoins. However, you actually only end up producing 548 Bitcoins because the hash price is continuously decreasing. In other words, to maintain any given level of Bitcoin production, you need to buy new mining rigs much faster than their estimated useful life would suggest, right? So even if you're operating the mining rig for 3 years, technically the estimated useful life is 3 years. But if you want to maintain your given level of Bitcoin production, you have to replace those mining rigs a lot faster than every 3 years. So in reality, the depreciation expense that these Bitcoin miners use with the straight line method, I think is a massive underestimate to the real economic depreciation, which is indeed continuous and not really applicable to the straight line method that they use. And substantially all Bitcoin miners, as we described earlier, all the Bitcoin miners are losing money even after the increase in the price of Bitcoin as a result of the election. They're still going to be losing money. And in fact, the losses are probably even worse than they look due to this issue of the depreciation that we just talked about. So substantially all Bitcoin publicly traded Bitcoin miners are burning cash, and they fund their losses by issuing new shares to the public. So these are, I think, the largest three Bitcoin miners by hash rate are Riot Platforms, Marathon Digital, and CleanSpark. And you can see all of them have had a monster increase in their share count over the years. And so, in the case of both Riot and Marathon in 2021, they each had about 100 million shares. That's tripled to 300 million. CleanSpark started with about 50 million shares. That has increased 5 times to 250 million shares. So the share counts are exploding as they need to issue more shares to fund their losses and also fund their expansion. Now, there's a saying that the market can stay irrational longer than you can stay solvent. Where even if I think that the shares of Bitcoin, you say even if you think Bitcoin itself is overvalued, well, if the people who currently hold Bitcoin never want to sell, maybe that overvalued state can continue for a very long period of time. Now, as a short seller, what I like about the Bitcoin miners, why I like shorting a lot of the Bitcoin mining stocks, is because they lose so much money. They burn so much cash because they're constantly needing to buy new mining rigs, and they have such massive depreciation expense that they need to keep buying new mining rigs. They consume so much cash that they have to issue so many new shares. And even if the existing shareholders don't sell, there's always a natural seller of the company itself selling more and more shares onto the market. And that selling pressure will eventually, in the long run, cause the stock price to go down because it's all about supply and demand. And then finally, another thing you have to understand with cryptocurrencies in general, sort of as we talked about earlier, the Bitcoin increased massively following the election of Donald Trump. In reality, Trump has talked a lot of rhetoric about how he's pro crypto, but in reality, insofar as real policies that he could actually implement, there's not much that he could realistically do that will benefit the price of Bitcoin. Really, the only thing he can do is the national strategic reserve thing, but that is already legally questionable given the issue of the fact that a lot of these bitcoins that the government has in custody may actually need to be returned to the victims. So it's questionable legally if Trump will even be able to do this national Bitcoin reserve thing that he's talking about. And even if he does, it's only 1% of the supply of Bitcoin. So it's kind of hard to see how that can justify a 40% increase in the Bitcoin price after his election. And one thing that I think a conclusion that I've sort of come to is that the Bitcoin market is completely irrational because at the end of the day, cryptocurrencies are fake money. And if you buy a cryptocurrency, you are effectively trading real money in exchange for fake money. You're exchanging your real US dollars in exchange for a fake digital coin that somebody made that you can't even use to buy anything and is not legal tender. So why would anybody do that? Why would anybody trade real money for fake money? Well, that's not a rational thing to do. No rational person would invest in cryptocurrencies because they have no utility and you can't even do anything with them. So, uh, when all of the people who trade in the cryptocurrency market, by definition, are irrational, the price action of the cryptocurrencies themselves is also irrational. For example, following the election of Donald Trump, the price of Dogecoin skyrocketed massively. It achieved a market capitalization of $60 billion and became the sixth largest cryptocurrency in the world. And why did this happen? It's because Donald Trump announced that he would create the Department of Government Efficiency, which has an acronym of Doge, which is the same as Dogecoin. So this is completely nonsensical, completely idiotic that people actually see this Department of Government Efficiency and go out and buy Dogecoin. And that's the point I'm trying to make, is that these people are not rational. The people who trade cryptocurrencies are not rational. So it'd be very dangerous if you were to, say, short a cryptocurrency itself. However, I feel much more comfortable shorting the Bitcoin mining stocks because, well, in the short term, they also can have extreme volatility. In the long run, as these companies burn cash and incinerate capital and increase their share counts, eventually, based on the laws of supply and demand, their share prices have to collapse as their share count hyperinflates. All right, so I think that is about everything we have to talk about Bitcoin miners. As always, if you have any opinions or thoughts about Bitcoin or Bitcoin mining, please let us know in the comment section below, and we will see you all on next week's video.